Let's get to your earnings as well. Obviously, I'm sure you know the market's not taking this well. Your stock's down 9%. That could be just one day. We'll see what happens with that. But there seems to be a focus on your guidance for this half right now that we're coming in. Why the weakness there?
Oh, look, we've seen softer spreads, no question, for the first half in the new financial year. We've come off a fantastic result, so the full year result was terrific. We have seen softer spreads. Those spreads have started to correct in the last little bit as we've seen iron ore costs and coal costs come off and steel prices recover a little in North America. They're still a bit softer in the Southeast Asian markets, but we're guiding to a softer spread for the first half, which is really the macro effect. Right. And I suspect that's what the market's what the market's looking at.
In terms of you approved this expansion in your North Star project in Ohio, my question for you is, given the outlook that you just outlined there, how confident are you that the market can actually absorb additional capacity at this point?
Oh, look, we're really confident. What I would say about the North Star investment is that's a 30-year investment for us. They're not investments that you make for the next half or the next two halves. So that's a 30-year investment for us. We think we've got a very good cost position in that asset. We're in a good region with strong demand. There's plenty of scrap supply. So from our point of view, we see the long-term potential of that asset. It's a terrific asset already, and we've got a great team there. And as I said, a 30-year investment for us. So we continue to be very confident about the long-term outlook for the United States economy.
There's obviously growing concern about a potential global recession. I'm wondering, what are the steel markets telling you about the health of the global economy?
Yeah, look, we see a bit of a mixed story. Certainly in Europe, there's no question we've seen some softening. We sell some coke into that market, so we've certainly seen a reduction in demand. In the US, the economy is still okay. We sell to buildings customers, building construction, automobile construction remains strong. So for our markets and our segments in North America, that market is still okay. We've seen some price softening in the Southeast Asian market in recent times, but the Chinese economy is still very strong, and a lot of steel's being consumed internally. Here in Australia, in the half we've just been through, so for the full year, a slight softening in residential activity, but from our point of view, detached dwellings, which is the area that we particularly focus on, as opposed to high-rise apartments. Again, just a moderate softening from pretty high historical levels. So generally the regions that we operate in, Asia, Australia and North America, the markets are okay.
Goldman Sachs, they think that iron ore prices may hit $100. Is that in line with your estimates, and how would that impact the business?
Well, look, we've seen iron ore jump to $120 a tonne. It's now come back and is operating in the 80 to 90 level. $100 a tonne seems like a high level, but we did see the supply shock after the tragedy in South America 12 months ago. Certainly that caused the price to spike on the back of still strong demand out of China in particular. But in recent weeks we've seen that price fall back into the $80, $90 range. So look, it's probably Goldman Sachs probably have a better idea of forecasting iron ore than we do. What we've tried to do is build a business that means we are resilient almost irrespective of what happens to the commodity prices.
Mark, you get a substantial part of your business from outside Australia. How big of a concern is the weak currency for you when you report that, of course, in your home currency? Are you hedged? Is that something that's more a concern now than it was, say, 12 months ago?
Yeah, no, look, we're almost naturally hedged in terms of the way our assets and where our revenues come from. So we're almost naturally hedged. We tend not to take large hedge positions. We operate in the currencies in the countries, obviously, that we have operations. So from our point of view, no significant hedging or no requirement to hedge. Clearly, a stronger US dollar or a weaker Aussie dollar, as it turns out, sees some translation of earnings back from our North American business. But again, those things chop and change. We're not really forecasters of currency, but we continue to build our business in the Asean footprint, and of course with the announcement today in North Star, a much bigger investment in the North American market.
Mark, final question. Longer term, Southeast Asia is a a treasure trove, if you will, of opportunities, just given the sort of infrastructure needs that they have there. But you also have competition from Chinese exporters and producers. What is that dynamic like now in terms of competition with Chinese mills, and how do you see that over the next 10 years?
So look, we've seen export levels out of China in the 50 to 60 million tonne a year range. That's been as high as 120, so certainly it's pulled back from the peaks that we saw some years ago, and that's good for pricing in the region. We've seen China probably export more in the value-added end, so the coated and painted end, which tends to be more of a focus for us. But I agree with you. I look at the Asean market and think it is a treasure trove of opportunity. We've been in Asia for decades, and we're spread right across the Asian region, including in China and India as well. So we still see long-term growth in those markets and the need for more sophisticated and higher quality building products, which is really what we believe we do quite well. So I agree with you. We see the ASEAN region as a terrific long-term growth proposition.